Imagine waking up every morning without worrying about bills. Picture having the freedom to pursue your passions, travel, or start that business you've always dreamed of. This isn't just a fantasy, it's financial freedom, and it's within your reach. In 2024, the path to mastering your money is clearer than ever before, and I'm here to be your guide. Today, I'm going to share strategies that have helped thousands of people transform their financial lives. These aren't get-rich-quick schemes or complex financial jargon. These are practical, proven methods that anyone can use to take control of their finances and build lasting wealth. By the end of this video, you'll have a personalized blueprint for your financial freedom. You'll know exactly where you stand financially, where you want to go, and most importantly, how to get there. I promise that if you apply the principles we'll discuss today, you'll be on your way to a more secure and prosperous financial future. In the next hour, we're going to cover everything you need to know to master your money. You'll learn how to assess your current financial situation with clarity and honesty. We'll explore the art of creating a budget that actually works for you and discover proven strategies to eliminate debt. You'll find out how to build a robust emergency fund and increase your income in today's economy. We'll also dive into smart savings strategies that make your money work harder for you and discuss how to plan for your future without feeling overwhelmed. Finally, you'll discover how to develop the mindset of the financially successful. Are you ready to take control of your financial future? Let's dive in and start building your path to financial freedom. Let's dive into the heart of your finances with a powerful exercise I call the Financial X-ray. This isn't just about crunching numbers. It's about uncovering the truth of your financial health. Grab a pen and paper because we're about to embark on a journey of financial self-discovery. Understanding your current financial situation. 10 minutes. Welcome to the foundation of your financial journey. In the next 10 minutes, we're going to dive deep into your current financial situation. This isn't just about crunching numbers. It's about gaining clarity and setting the stage for your financial transformation. Let's start with assessing your income and expenses. This step is crucial because it gives you a clear picture of your cash flow. Begin by listing all your sources of income. This includes your salary, any side hustles, investment returns, rental income, basically every dollar that comes into your life. Be thorough. You might be surprised by income streams you've overlooked. Now for the expenses. This is where many people falter, but I promise you, the insights you gain here will be eye-opening. Start with your fixed expenses. Things like rent or mortgage, utilities, insurance premiums, and loan payments. These are relatively constant month to month. Next, tackle your variable expenses. This includes groceries, entertainment, clothing, and those impulse purchases we all make. Don't judge yourself here. We're just gathering data. Use your bank and credit card statements for the past 3 months to get an accurate picture. Here's a pro tip. Categorize your expenses. You might use broad categories like housing, transportation, food, entertainment, and so on. This categorization will help you identify areas where you might be overspending. Now subtract your total monthly expenses from your total monthly income. The result is your net cash flow. If it's positive, great! You have money left over each month to save or invest. If it's negative, don't panic. We've just identified an area for improvement. Let's move on to calculating your net worth. This is a snapshot of your financial health at a given moment. Start by listing all your assets, things you own that have value. This includes cash in bank accounts, investments, stocks, bonds, mutual funds, real estate, vehicles, valuable personal property, jewelry, art, etc., retirement accounts. Next, list all your liabilities, the debts you owe, mortgage balance, car loans, student loans, credit card debt, personal loans. Now subtract your total liabilities from your total assets. The result is your net worth. Don't be discouraged if it's low or even negative. Many people start their financial journey here. The key is to track this number over time and watch it grow. Here's why net worth is so important. It gives you a holistic view of your financial situation. Your income could be high, but if you're deep in debt, your net worth might be low. Conversely, you might have a modest income but a high net worth if you've been diligent about saving and investing. Now, let's identify your financial strengths and weaknesses. This is where we take all the data we've gathered and turn it into actionable insights. Start with your strengths. Maybe you're great at living below your means, or you've been consistent with your retirement contributions. Perhaps you have a valuable skill that allows you to earn a high income. Recognizing these strengths is crucial because they're the foundation you'll build upon. Next, let's tackle the weaknesses. Be honest with yourself here. This is how we grow. Common weaknesses include high levels of consumer debt, lack of emergency savings, overspending in certain categories, inadequate insurance coverage, no retirement planning. Remember, identifying weaknesses isn't about beating yourself up. It's about spotting opportunities for improvement. Now let's do a quick financial ratio check. These ratios can give you a quick snapshot of your financial health. 1. Savings ratio. Monthly savings, monthly income, x 100. Aim for at least 20%. 1. If you're below this, increasing your savings is a priority. 2. Debt to income. Ratio, monthly debt payments, monthly income, x 100, keep this below 36%. 2. If it's higher, focusing on debt repayment should be a priority. 3. Emergency fund ratio, emergency fund, monthly expenses, aim for 6 months. 3. If you're below this, building your emergency fund is crucial. Lastly, let's talk about your money mindset. Your beliefs about money significantly impact your financial behaviors. Ask yourself, do you feel in control of your finances, or do you feel money controls you? Do you view money as a tool for freedom or a source of stress? Are you comfortable talking about money, or do you avoid the subject? Understanding your money mindset can help you identify subconscious barriers to financial success. As we wrap up this section, take a moment to reflect on what you've learned. You now have a clear picture of your income, expenses, net worth, financial strengths and weaknesses, key financial ratios, and money mindset. This knowledge is power. It's the foundation upon which we'll build your financial freedom blueprint. In our next section, we'll use these insights to create a budget that aligns with your goals and values. Remember, understanding your current financial situation isn't about judgment. It's about awareness. It's the first step in taking control of your financial future. No matter where you're starting from, you have the power to improve your financial situation. Stay with me because the best is yet to come. Crafting a robust budget, 10 minutes. Now that we've got a clear picture of your financial situation, it's time to take control of your cash flow. That's right, we're going to craft a budget that not only works but becomes your roadmap to financial success. Don't worry if the word budget makes you cringe. By the end of this section, you'll see it as your ticket to financial freedom. Let's start by exploring 3 powerful budgeting methods. Remember, there's no one-size-fits-all approach. The best budget is the one you'll stick to, so let's find the perfect fit for you. First up, we have the 50-30-20 method. This approach is all about simplicity and flexibility. Here's how it works. 50% of your after-tax income goes to needs. These are your must-haves: housing, food, utilities, transportation, and minimum debt payments. 30% goes to wants. This covers your nice-to-haves, dining out, entertainment, hobbies, and those little luxuries that make life enjoyable. 20% is allocated to savings and additional debt payments. This includes building your emergency fund, saving for retirement, and paying down debt beyond the minimum payments. The beauty of the 50-30-20 method is its simplicity. It gives you a framework without being overly restrictive. It's particularly good for those who feel overwhelmed by tracking every penny. Next, let's talk about the zero-based budget. This method is for those who love detail and want complete control over every dollar. Here's the concept. Your income minus your expenses should equal 0. But don't worry, this doesn't mean spending everything. It means giving every dollar a job, including saving and investing. Here's how to implement a zero-based budget. 1. Start with your monthly income. 2. List all your expenses, including savings and debt payments. 3. Assign every dollar to a category until you reach 0. 4. Track your spending throughout the month to ensure you're sticking to your plan. The zero-based budget is fantastic for getting a granular view of your spending and ensuring every dollar is working towards your financial goals. Lastly, we have the envelope system. This old-school method has gotten a modern makeover and can be incredibly effective, especially for overspenders. Here's how it works. 1. Determine your budget categories, e.g., groceries, entertainment, gas. 2. Create an envelope for each category. 3. At the beginning of the month, fill each envelope with the allotted cash. 4. Once an envelope is empty, that's it for the month. No more spending in that category. The physical act of handling cash and seeing it dwindle can be a powerful psychological tool for curbing overspending. And don't worry, you can use a digital version of this system if you prefer not to carry cash. Now let's talk about using technology to make budgeting easier. Gone are the days of pencil and paper ledgers. Today, numerous apps and tools can do the heavy lifting for you. Popular budgeting apps include 1. Mint, great for automatic transaction categorization and bill tracking. 2. YNAB, you need a budget, ideal for zero-based budgeting enthusiasts. 3. Personal Capital, excellent for tracking both your budget and investments. 4. Every Dollar, a user-friendly option for those new to budgeting. These apps can connect to your bank accounts and credit cards, automatically categorizing your transactions. Many offer insights into your spending patterns and can even predict future expenses based on your history. But remember, technology is just a tool. The real power comes from regularly reviewing your budget and making informed decisions based on the data. Now let's address the elephant in the room, sticking to your budget. This is where many people struggle, but I've got some tried and true tips to help you stay on track. 1. Make it realistic. Don't set yourself up for failure with an overly restrictive budget. 1. Leave some room for spontaneity and fun. 2. Use the power of automation. Set up automatic transfers to your savings account or automatic payments for bills. 2. What's out of sight is out of mind. 3. Implement the 24-hour rule. For non-essential purchases, wait 24 hours before buying. 3. This helps curb impulse spending. 4. Find an accountability partner. Share your goals with a friend or family member who can check in on your progress. 5. Celebrate small wins. Did you stick to your grocery budget this month? 5. Treat yourself, within reason, of course. 6. Make it visual. Use charts or graphs to track your progress. 6. Seeing your debt decrease or savings increase can be incredibly motivating. 7. Review and adjust regularly. Your budget isn't set in stone. 7. Life changes and your budget should too. 7. Review it monthly and make adjustments as needed. 8. Use cash for problem areas. If you tend to overspend in certain categories, use cash only for those expenses. 9. Plan for irregular expenses. Don't let annual subscriptions or seasonal costs throw you off track. 9. Budget for them monthly. 10. Give yourself grace. If you slip up, don't throw in the towel. 10. Acknowledge it, learn from it, and move forward. Remember, budgeting is a skill, and like any skill, it takes practice to master. Don't get discouraged if it doesn't click immediately. Keep at it, and you'll find your groove. Here's a pro tip. Start with tracking your spending for a month before implementing a strict budget. This gives you a realistic baseline and helps you set achievable goals. As we wrap up this section, I want you to remember that a budget isn't about restriction. It's about intention. It's about making sure your money is working towards your goals and values. It's about taking control of your financial life rather than letting it control you. In our next section, we're going to tackle something that keeps many people up at night: debt. We'll use the budgeting skills you've just learned to create a powerful debt repayment strategy. Stay with me because financial freedom is just around the corner. Mastering debt management, 10 minutes. Now that we've got your budget under control, it's time to tackle one of the biggest obstacles to financial freedom: debt. Don't worry if you feel overwhelmed. By the end of this section, you'll have a clear strategy to manage and eliminate your debt, paving the way for a brighter financial future. Let's start by understanding the difference between good debt and bad debt. Yes, you heard that right. Not all debt is created equal, and some types of debt can actually be beneficial in the long run. Good debt is generally considered an investment in your future. It's debt that has the potential to increase your net worth or generate long-term income. Examples of good debt include: 1. Mortgage. When you buy a home, you're investing in an asset that typically appreciates over time. 2. Student loans. Education can increase your earning potential, making this a form of investment in yourself. 3. Business loans. If used wisely, these can help you start or expand a business, potentially increasing your income. Good debt usually has lower interest rates and may offer tax benefits. However, it's crucial to remember that even good debt needs to be managed responsibly. On the other hand, bad debt typically doesn't provide long-term benefits and often comes with high interest rates. Examples include: 1. Credit card debt. High interest rates can make this type of debt spiral out of control quickly. 2. Payday loans. These often come with exorbitant interest rates and fees. 3. Auto loans for depreciating vehicles. Cars typically lose value over time, making this a less ideal form of debt. Understanding this distinction is crucial because it helps you prioritize which debts to tackle first and which might be okay to maintain for a while. Now let's dive into strategies for paying off debt. We'll focus on two popular methods: the snowball method and the avalanche method. The debt snowball method. This approach focuses on paying off your smallest debts first, regardless of interest rates. Here's how it works. 1. List all your debts from smallest to largest. 2. Make minimum payments on all debts except the smallest. 3. Put any extra money towards the smallest debt. 4. Once the smallest debt is paid off, move to the next smallest. The main advantage of this method is psychological. Quick wins can provide motivation and momentum, encouraging you to stick with your debt repayment plan. The debt avalanche method. This method prioritizes paying off debts with the highest interest rates first. Here's the process. 1. List all your debts from highest interest rate to lowest. 2. Make minimum payments on all debts except the one with the highest interest rate. 3. Put any extra money towards the highest interest debt. 4. Once that's paid off, move to the debt with the next highest interest rate. The avalanche method is mathematically optimal, as it saves you the most money and interest over time. However, it may take longer to see tangible progress, especially if your highest interest debts are also your largest. So which method should you choose? It depends on your personality and financial situation. If you need quick wins to stay motivated, the snowball method might be best. If you're disciplined and want to minimize interest payments, go for the avalanche method. Remember, the best method is the one you'll stick to consistently. Now let's talk about a powerful tool in your debt management arsenal: negotiating with creditors. Many people don't realize that credit terms are often negotiable. Here are some tips for effective negotiation. 1. Do your homework, know your account details, and have a clear idea of what you're asking for before you call. 2. Be polite but persistent. Remember, you're more likely to get help if you're courteous. 3. Explain your situation. If you're facing hardship, let them know. 3. Many creditors have hardship programs. 4. Ask for lower interest rates. If you've been a good customer, you might qualify for a lower rate. 5. Request a payment plan. If you're struggling to make payments, ask about setting up a more manageable plan. 6. Get any agreements in writing. This protects you in case of future disputes. 7. Consider working with a credit counseling agency. They can often negotiate on your behalf and may have established relationships with creditors. Remember, creditors would rather work with you than risk you defaulting on your debt entirely. Lastly, let's discuss improving your credit score. Your credit score is crucial for your overall financial health, affecting everything from loan approvals to interest rates. Here are key strategies to boost your score. 1. Pay your bills on time. Payment history is the most significant factor in your credit score. 2. Reduce your credit utilization. Try to use less than 30% of your available credit. 3. Don't close old credit accounts. Length of credit history matters, so keep old accounts open even if you're not using them. 4. Limit new credit applications. Each hard inquiry can temporarily lower your score. 5. Diversify your credit mix. Having different types of credit, e.g. credit cards, installment loans, can positively impact your score. 6. Check your credit report regularly. Dispute any errors you find promptly. 7. Consider becoming an authorized user. If a family member has excellent credit, ask if you can become an authorized user on their account. 8. Use a secured credit card. If you're building credit from scratch, this can be a good starting point. 9. Keep balances low. Even if you pay in full each month, high balances reported to credit bureaus can hurt your score. 10. Be patient. Improving your credit score takes time. 10. Consistent good habits will pay off in the long run. As we wrap up this section on debt management, remember that becoming debt-free is a journey, not a sprint. It requires patience, discipline, and consistent effort. But the payoff is enormous. Reduced stress, increased financial flexibility, and a solid foundation for building wealth. In our next section, we'll discuss how to build an emergency fund to prevent future debt and provide financial security. Stay tuned, because this is where your journey to true financial freedom really takes off. Now that we've tackled budgeting and debt management, it's time to focus on a crucial aspect of financial stability: your emergency fund. This financial safety net is your secret weapon against life's unexpected curveballs. And by the end of this section, you'll understand why it's so important and how to build one effectively. Let's start by discussing the importance of having a financial safety net. Life is unpredictable. Job losses, medical emergencies, car repairs, or unexpected home maintenance can all wreak havoc on your finances if you're not prepared. An emergency fund acts as a buffer, preventing you from falling into debt or derailing your other financial goals when these surprises occur. Here are some key reasons why an emergency fund is crucial. 1. Stress reduction. Knowing you have a financial cushion can significantly reduce your stress levels. 1. You'll sleep better at night knowing you're prepared for the unexpected. 2. Avoiding high-interest debt. Without an emergency fund, you might be forced to rely on credit cards or loans to cover unexpected expenses, potentially leading to a cycle of debt. 3. Financial flexibility. An emergency fund gives you options. 3. If you lose your job, you have time to find the right new position rather than taking the first offer out of desperation. 4. Protecting your investments. With an emergency fund, you won't need to tap into your long-term investments when emergencies arise, allowing your money to continue growing. 5. Relationship saver. Money problems are a leading cause of relationship stress. 5. An emergency fund can help prevent financial disagreements with your partner. Now that we understand why an emergency fund is so important, let's talk about how much you should aim to save. The general rule of thumb is to have 3 6 months of living expenses saved. However, this can vary based on your personal circumstances. Consider saving more if you're the sole breadwinner in your household, you work in a volatile industry, or are self-employed. You have dependents or pets that might require expensive care. You have a chronic medical condition. On the other hand, you might aim for the lower end of the range if you have a stable job in a secure industry. You have multiple income streams. You have other liquid assets you could tap in an emergency. Remember, your emergency fund should cover your essential expenses, not your current lifestyle. Calculate your bare-bones budget: housing, utilities, food, transportation, and essential debt payments. And use this as your baseline. Now, where should you keep your emergency fund? The key is to find a balance between accessibility and earning potential. Your emergency fund should be 1. Easily accessible. You need to be able to get to this money quickly in case of an emergency. 2. Liquid. The money should be in cash or cash equivalents, not tied up in investments that could lose value. 3. Separate from your regular checking account. This helps avoid the temptation to dip into it for non-emergencies. Considering these factors, here are some good options. 1. High-yield savings account. These online accounts often offer higher interest rates than traditional banks. 2. Money market account. These can offer slightly higher interest rates and may come with check-writing privileges. 3. Short-term certificates of deposit, CDs. Consider a CD ladder for slightly higher returns while maintaining some liquidity. Avoid keeping your emergency fund in stocks or mutual funds. These can lose value and may not be easily accessible. Long-term CDs. The penalties for early withdrawal can be steep. Your home equity. This isn't liquid and could be risky if housing values decline. Now let's discuss some strategies for fast-tracking your emergency fund. Building up 3-6 months of expenses can seem daunting, but with these tips, you'll be surprised at how quickly you can make progress. 1. Start small. Begin with a goal of $1,000. 1. This can cover many minor emergencies and give you a sense of accomplishment. 2. Automate your savings. Set up automatic transfers from your checking account to your emergency fund each payday. 2. What you don't see, you won't miss. 3. Use windfalls. Wisely dedicate tax refunds, work bonuses, or gift money to your emergency fund. 4. Try a savings challenge. The 52-week challenge, where you save $1 the first week, $2 the second, and so on, can help you save $1,378 in a year. 5. Cut expenses and redirect. Look for areas in your budget where you can cut back and immediately transfer that amount to your emergency fund. 6. Sell unused items. Have a garage sale or sell items online. 6. Every little bit helps. 7. Use cashback apps and credit cards. Put all your cashback rewards directly into your emergency fund. 8. Pick up a side hustle. Even a few hours a week can significantly boost your savings. 9. Save your change. Use a digital roundup app or physically save your spare change. 10. Make it a game. Challenge yourself or compete with a friend to see who can save more in a given time period. Remember, building an emergency fund is a process. Don't get discouraged if it takes time. Even small, consistent contributions will add up over time. As you're building your fund, it's crucial to establish clear guidelines for what constitutes an emergency. This helps prevent you from dipping into the fund for non-emergencies. True emergencies typically include job loss or significant regular maintenance costs. If you do need to use your emergency fund, make replenishing it a top priority. Treat it like any other essential bill. Lastly, remember to review and adjust your emergency fund regularly. As your life circumstances change, perhaps you buy a home, have children, or change careers, your emergency fund needs may change too. Building an emergency fund is one of the most important steps you can take towards financial security. It provides peace of mind and a solid foundation for all your other financial goals. In our next section, we'll discuss strategies for increasing your income, which can help you build your emergency fund even faster and accelerate your journey to financial freedom. Stay tuned, because the path to financial success is about to get even more exciting. Increasing your income, 10 minutes. Now that we've covered budgeting, debt management, and building an emergency fund, it's time to focus on a game-changing aspect of personal finance: increasing your income. While cutting expenses is important, there's a limit to how much you can save. However, your earning potential is virtually limitless. In this section, we'll explore strategies to boost your income, setting you on a fast track to financial freedom. Let's start with one of the most direct ways to increase your income: negotiating a raise at your current job. Many people feel uncomfortable asking for more money, but remember, if you don't ask, the answer is always no. Here are some strategies to help you successfully negotiate a raise. Timing is everything. Choose the right moment. After completing a big project, during a performance review, or when taking on new responsibilities are all good times to broach the subject. Do your research. Know your worth in the job market. Use sites like Glassdoor, PayScale, or industry-specific salary surveys to understand the typical pay range for your position and experience level. Document your achievements. Keep a record of your accomplishments, especially those that have directly benefited the company. Quantify your contributions where possible, e.g., increased sales by 15% or reduced costs by $10,000. Practice your pitch. Rehearse your request with a friend or family member. Be prepared to articulate why you deserve a raise clearly and confidently. Be specific. Instead of a vague request for a raise, come prepared with a specific number or percentage based on your research and contributions. Think beyond salary. If a direct pay increase isn't possible, consider negotiating for other benefits like additional vacation days, flexible working hours, or professional development opportunities. Have a backup plan. If a raise isn't possible now, ask about setting specific goals and a timeline for revisiting the conversation. Stay professional. Regardless of the outcome, maintain a positive and professional attitude. If the answer is no, ask for feedback on what you can do to earn a raise in the future. Remember, negotiating your salary is a normal part of professional life. Employers expect it, and it shows that you value your work and contributions. Now let's explore some side hustle ideas for 2024. A side hustle can be a great way to diversify your income streams and accelerate your financial goals. Here are some promising options. Freelancing. Utilize platforms like Upwork, Fiverr, or Freelancer to offer your skills in writing, graphic design, programming, or virtual assistance. Online tutoring. With the rise of remote learning, online tutoring has become more popular than ever. Platforms like VipeKid, Chegg, or TutorMe connect tutors with students worldwide. Content creation. Start a blog, YouTube channel, or podcast about a topic you're passionate about. While it takes time to build an audience, successful content creators can earn through ads, sponsorships, and affiliate marketing. E-commerce. Set up an online store using platforms like Shopify or Etsy. You could sell handmade items, dropship products, or even create print-on-demand merchandise. Real estate. Consider renting out a spare room on Airbnb or investing in rental properties. Real estate can provide both passive income and long-term appreciation. Rideshare or delivery services. Companies like Uber, Lyft, DoorDash, or Instacart offer flexible opportunities to earn extra income. Virtual events planning. With many events going digital, there's a growing demand for virtual event planners who can coordinate online conferences, webinars, and virtual team-building activities. Online fitness coaching. If you're passionate about health and fitness, consider offering online personal training or nutrition coaching services. Social media management. Many small businesses need help managing their social media presence. If you're savvy with social platforms, this could be a great opportunity. Tech support. With more people working from home, there's an increased need for remote tech support. If you're tech savvy, this could be a lucrative side hustle. When choosing a side hustle, consider your skills, interests, and the time you can realistically dedicate to it. Start small and scale up as you learn and grow. Lastly, let's discuss developing high-income skills. These are skills that are in high demand and can significantly boost your earning potential. Here are some high-income skills to consider developing in 2024. Data analysis. With the increasing importance of big data, professionals who can analyze and interpret data are in high demand across industries. Digital marketing. As businesses continue to shift online, expertise in SEO, social media marketing, and content marketing is crucial. UX/UI design. User experience and user interface design are critical for businesses looking to create intuitive, user-friendly digital products. Cybersecurity. As cyber threats evolve, the need for skilled cybersecurity professionals continues to grow. Artificial intelligence and machine learning. These technologies are revolutionizing industries, and professionals with these skills are highly sought after. Blockchain development. While the crypto market fluctuates, the underlying blockchain technology has wide-ranging applications beyond cryptocurrency. Cloud computing. As more businesses move to the cloud, expertise in platforms like AWS, Azure, or Google Cloud is valuable. Project management. The ability to effectively lead teams and manage complex projects is always in demand. Sales. High-level sales skills can lead to lucrative careers across various industries. Emotional intelligence. While not a technical skill, the ability to understand and manage emotions, both your own and others, is increasingly recognized as crucial in the workplace. To develop these skills, Take online courses. Platforms like Coursera, edX, or Udemy offer courses in these areas, often with certificates upon completion. Attend workshops and conferences. These can provide intensive learning experiences and valuable networking opportunities. Seek mentorship. Find someone who has succeeded in your area of interest and learn from their experience. Practice. Many of these skills can be honed through personal projects or volunteer work. Stay updated. These fields evolve rapidly, so make continuous learning a habit. Remember, developing high-income skills is an investment in yourself. It takes time and effort, but the potential returns in terms of increased earning power and career opportunities are substantial. As we wrap up this section on increasing your income, remember that combining these strategies, negotiating a raise, starting a side hustle, and developing high-income skills can lead to significant growth in your earning potential. This increased income, when combined with the budgeting and saving strategies we've discussed earlier, can supercharge your journey to financial freedom. In our next section, we'll explore smart saving strategies to make the most of your increased income. Stay tuned, because we're about to unlock the secrets to accelerating your wealth-building journey. Smart saving strategies, 5 minutes. Now that we've explored ways to increase your income, it's time to focus on making your money work harder for you. In this section, we'll dive into smart saving strategies that can help you maximize your savings and accelerate your journey to financial freedom. We'll cover high-yield savings accounts, automating your savings, and money-saving apps and tools that can supercharge your savings efforts. Let's start with high-yield savings accounts. These accounts are a game changer for savers, offering interest rates significantly higher than traditional savings accounts. Here's what you need to know. What are high-yield savings accounts? High-yield savings accounts are typically offered by online banks or credit unions. They can offer higher interest rates because these institutions have lower overhead costs compared to traditional brick-and-mortar banks. Benefits of high-yield savings accounts: higher interest rates. While traditional savings accounts might offer 0.1% to 0.1% APY, annual percentage yield, high-yield accounts can offer 1% to 2% or even higher, depending on market conditions. FDIC insurance. Like traditional savings accounts, high-yield accounts at FDIC-insured banks are protected up to $250,000 per depositor. Easy access. While not as immediate as a checking account, you can typically transfer funds to your linked checking account within 1-3 business days. Things to consider. Minimum balance requirements. Some accounts require a minimum balance to earn the highest rate or avoid fees. Rate changes. Interest rates can fluctuate based on market conditions. Online only. Many high-yield accounts are offered by online-only banks, which might not have physical branches. How to choose a high-yield savings account. Compare APYs from multiple banks. Check for fees and minimum balance requirements. Look for accounts with convenient features like mobile check deposit or easy transfers. Read customer reviews to gauge the quality of customer service. Best practices. Use high-yield accounts for your emergency fund or short-term savings goals. Regularly check rates and be willing to switch banks if significantly better rates become available. Remember, even small differences in interest rates can add up over time. Next, let's talk about automating your savings. This strategy leverages the power of habit and removes the temptation to spend money before you save it. Here's how to effectively automate your savings. Set up direct deposit. If your employer offers direct deposit, have a portion of your paycheck automatically deposited into your savings account. Use automatic transfers. Set up recurring transfers from your checking to your savings account on paydays or specific dates each month. Roundup programs. Many banks offer programs that round up your purchases to the nearest dollar and transfer the difference to your savings account. Save your raises. When you get a raise, immediately set up an automatic transfer for the additional amount to your savings account. Automate bill payments. This ensures you don't miss payments and incur late fees, indirectly helping you save money. Use apps for micro-saving. Apps like Acorns or Digit can automatically save small amounts based on your spending habits. Set it and forget it. Once you've set up your automated savings, resist the urge to constantly check or adjust them. Let the system work for you. Regularly review and adjust. While you shouldn't tinker constantly, do review your automated savings every few months to ensure they still align with your goals and financial situation. Automating your savings takes advantage of psychological principles. By removing the need for constant decision-making, you reduce the chances of skipping savings contributions. It's a set-it-and-forget-it approach that can lead to significant savings over time. Lastly, let's explore some money-saving apps and tools that can help you stretch your dollars further. Budgeting apps. Mint offers comprehensive budgeting features and bill tracking. Yenab, you need a budget, uses a zero-based budgeting approach. Personal Capital combines budgeting with investment tracking. Cashback and rewards apps. Rakuten offers cashback for online shopping. Ibotta provides cashback on grocery and retail purchases. Fetch rewards. Earn points for scanning receipts, redeemable for gift cards. Coupon and deal apps. Honey automatically applies coupon codes when shopping online. Retail Monat aggregates coupons and promo codes for various retailers. Gas Buddy helps find the cheapest gas prices in your area. Subscription tracking. Truebill helps identify and cancel unwanted subscriptions. Trim negotiates bills and cancels subscriptions on your behalf. Investing and micro-investing. Robinhood commission-free stock trading. Acorns rounds up purchases and invests the spare change. Price comparison tools. Price Grabber compares prices across multiple retailers. Camel tracks price history on Amazon. Bill negotiation. Bill Shark negotiates bills on your behalf to lower your monthly expenses. Meal planning. Mealime helps plan meals and create grocery lists, potentially reducing food waste and impulse purchases. Travel savings. Hopper predicts flight prices and alerts you to the best time to buy. Airbnb can offer cheaper alternatives to hotels for accommodations. Debt payoff apps. Undebt DIT helps create and stick to a debt payoff plan. Debt Payoff Planner visualizes your debt payoff journey. When using these apps and tools, keep these tips in mind. Security first. Only use reputable apps and be cautious about sharing sensitive financial information. Avoid overspending. Don't let cashback or rewards tempt you into unnecessary purchases. Read the fine print. Understand any fees or terms associated with the apps you use. Combine strategies. Use multiple apps in conjunction for maximum savings. Regular review. Periodically review which apps are providing the most value and adjust accordingly. As we wrap up this section on smart saving strategies, remember that the key to successful saving is consistency and intentionality. High-yield savings accounts provide a better return on your saved money. Automating your savings ensures you consistently put money aside before you have a chance to spend it. And money-saving apps and tools can help you find additional ways to cut costs and boost your savings. By combining these strategies with the budgeting, debt management, and income-increasing techniques we've discussed earlier, you're setting yourself up for financial success. In our next section, we'll explore how to plan for your future, including retirement planning and long-term wealth building. Stay tuned because we're about to unlock the secrets to securing your financial future. As we've progressed through our financial journey, we've covered budgeting, debt management, saving strategies, and increasing your income. Now, it's time to look ahead and plan for your future. In this section, we'll explore how to set effective financial goals, understand the basics of retirement planning, and cover essential insurance needs. By the end of this section, you'll have a roadmap for your financial future and the knowledge to protect yourself along the way. Let's start with setting short-term and long-term financial goals. Goal setting is crucial because it gives direction to your financial efforts and helps you stay motivated. Here's how to set effective financial goals. Short-term goals, 0-2 years. These are immediate objectives that you want to achieve in the near future. Examples include building an emergency fund, paying off credit card debt, saving for a vacation, making a major purchase like a new appliance. Medium-term goals, 2-5 years. These goals bridge the gap between your immediate needs and your long-term vision. They might include saving for a down payment on a house, starting a business, paying off student loans, saving for a wedding. Long-term goals, 5 years. These are your big-picture objectives that shape your financial future. Examples include saving for retirement, paying off your mortgage, funding your children's education, achieving financial independence. When setting your goals, use the SMART criteria. Specific. Clearly define what you want to achieve. Measurable. Quantify your goal so you can track progress. Achievable. Ensure your goal is realistic given your resources. Relevant. Align your goal with your values and long-term objectives. Time-bound. Set a deadline for achieving your goal. Remember, your goals should be personal to you. What matters most is that they reflect your values and aspirations. Once you've set your goals, write them down and review them regularly. This helps keep you accountable and allows you to adjust as your circumstances change. Now, let's dive into the basics of retirement planning. It's never too early to start planning for retirement. And the earlier you begin, the more time your money has to grow. Here are the key elements of retirement planning. Determine your retirement needs. Experts often suggest aiming for 70-80% of your pre-retirement income. However, this can vary based on your desired lifestyle in retirement. Understand different retirement accounts. 401k. an employer-sponsored plan that often includes matching contributions. Traditional IRA contributions are tax-deductible now, but withdrawals are taxed in retirement. Roth IRA. Contributions are made with after-tax dollars, but withdrawals in retirement are tax-free. SCP IRA and Solo 401k. Options for self-employed individuals. Take advantage of employer matching. If your employer offers a 401k match, try to contribute at least enough to get the full match. It's essentially free money! Diversify your investments. Don't put all your eggs in one basket. Spread your investments across different asset classes to manage risk. Understand asset allocation. As you get closer to retirement, you may want to shift to more conservative investments to protect your nest egg. Consider healthcare costs. Factor in potential healthcare expenses, including long-term care, in your retirement planning. Plan for Social Security. While it shouldn't be your only source of retirement income, understand how Social Security benefits work and when it's best for you to start claiming them. Regularly review and adjust. Your retirement plan should evolve as your life circumstances change. Review it annually and after major life events. Consider working with a financial advisor. A professional can help you create a comprehensive retirement strategy tailored to your specific needs and goals. Remember, the power of compound interest means that even small contributions can grow significantly over time. Start early and be consistent with your retirement savings. Lastly, let's cover insurance essentials. Insurance is a crucial part of your financial plan, protecting you and your loved ones from unexpected events. Here are the key types of insurance to consider. Health insurance protects you from high medical costs. Options include employer-sponsored plans, individual plans through the marketplace, or government programs like Medicare or Medicaid. Consider factors like premiums, deductibles, co-pays, and network coverage when choosing a plan. Don't forget about ancillary coverage like dental and vision insurance. Life insurance provides financial protection for your dependents in case of your death. Two main types: term life, coverage for a specific period, and whole life, coverage for your entire life with a cash value component. Consider your needs: income replacement, debt payoff, future expenses like children's education. The amount of coverage needed can depend on factors like your income, debts, and number of dependents. Disability insurance replaces a portion of your income if you're unable to work due to illness or injury. Short-term disability typically covers 3-6 months, while long-term disability can last for years. Many employers offer disability insurance, but you may want to consider supplemental coverage. Look at factors like the definition of disability benefit amount and waiting period before benefits kick in. Other important insurance types: auto insurance, required in most states and protects against liability and damage. Homeowners, renters. Insurance protects your property and possessions. Umbrella insurance provides additional liability coverage beyond your other policies. Long-term care insurance covers costs associated with extended medical care or assistance with daily living. When evaluating insurance needs, regularly review your coverage to ensure it still meets your needs. Don't be underinsured, but also avoid paying for coverage you don't need. Consider bundling policies with one insurer for potential discounts. Understand your policy's terms, conditions, and exclusions. Shop around and compare quotes from multiple providers. Remember, insurance is about managing risk. While it's an additional expense, the right insurance coverage can provide invaluable financial protection and peace of mind. As we conclude this section on planning for the future, take a moment to reflect on your long-term vision. Your financial goals, retirement plan, and insurance coverage should all align with this vision. Remember, planning for the future isn't a one-time task. It's an ongoing process that requires regular review and adjustment. In our final section, we'll discuss how to develop a wealth mindset and continue your financial education journey. Stay tuned, because we're about to unlock the psychological keys to long-term financial success. Developing a wealth mindset, 10 minutes. As we reach the final section of our financial journey, it's time to address perhaps the most crucial aspect of financial success: your mindset. In this section, we'll explore how to develop a wealth mindset, overcome limiting beliefs about money, adopt the habits of financially successful people, and commit to continual financial education. By the end of this section, you'll have the mental tools to support and accelerate your journey to financial freedom. Let's start by discussing the concept of a wealth mindset. A wealth mindset is a set of beliefs, habits, and behaviors that support financial growth and abundance. It's about seeing opportunities where others see obstacles, viewing money as a tool for creating value, and believing in your ability to achieve financial success. Now let's dive into overcoming limiting beliefs about money. These are often subconscious ideas that can hold us back from achieving our financial potential. Here are some common limiting beliefs and how to overcome them. Money is the root of all evil. This belief often stems from misunderstanding the actual quote, which is the love of money is the root of all evil. Money itself is neutral. It's a tool that can be used for good or bad. To overcome this, focus on the positive impact money can have. Think about how financial success can allow you to help others, support causes you care about, and create positive change in the world. I'm not good with money. This belief can become a self-fulfilling prophecy, leading to financial avoidance and poor decisions. To overcome this, recognize that financial skills can be learned. Start small by educating yourself on basic financial concepts and gradually build your knowledge and confidence. Rich people are greedy, unethical. This belief can subconsciously make you resist increasing your wealth out of fear of becoming someone you don't like. To overcome this, seek out examples of wealthy individuals who use their money for good. Remember, having more resources often means having more ability to make a positive impact. I'll never have enough money. This scarcity mindset can lead to stress, anxiety, and poor financial decisions. To overcome this, practice gratitude for what you have while working towards your goals. Focus on abundance and opportunities rather than lack. Making money has to be a struggle. This belief can make you resist opportunities that seem too easy or good to be true. To overcome this, recognize that while hard work is often necessary, it's also possible to work smart and leverage your skills and resources effectively. I don't deserve to be wealthy. This belief often stems from low self-esteem or guilt about past financial mistakes. To overcome this, work on building your self-worth separate from your net worth. Remember that past mistakes don't define your future potential. Wanting more money is selfish. This belief can make you feel guilty about pursuing financial success. To overcome this, reframe your financial goals in terms of the positive impact they can have on your life and the lives of others. I'll start saving and investing when I make more money. This belief leads to procrastination and missed opportunities for compound growth. To overcome this, start with whatever you can, no matter how small. Consistency is key in building wealth. To overcome these limiting beliefs, identify your beliefs. Reflect on your thoughts and feelings about money. Where did these beliefs come from? Challenge your beliefs. Are they based on facts or assumptions? Look for evidence that contradicts these beliefs. Reframe negative thoughts. Replace limiting beliefs with empowering ones. For example, change "I'm bad with money" to "I'm learning to manage money effectively." Surround yourself with positive influences. Seek out people, books, and resources that reinforce a positive money mindset. Practice affirmations. Use positive statements about money and wealth to reprogram your subconscious mind. Visualize success. Imagine yourself achieving your financial goals and living your ideal lifestyle. Take action. Start making small changes in your financial habits to build confidence and reinforce positive beliefs. Now, let's explore the habits of financially successful people. By adopting these habits, you can align your behaviors with your financial goals. Live below your means. Financially successful people understand the importance of spending less than they earn. This doesn't mean living a life of deprivation, but rather being mindful of expenses and prioritizing what truly brings value to their lives. Set clear financial goals. They have a clear vision of what they want to achieve financially and set specific, measurable goals to get there. These goals guide their financial decisions and keep them motivated. Invest in themselves. Successful people understand that their greatest asset is themselves. They continuously invest in their education, skills, and personal growth to increase their earning potential and adapt to changing markets. Diversify income streams. They don't rely on a single source of income. Instead, they create multiple income streams through investments, side hustles, or businesses to increase financial stability and growth potential. Automate finances. They use technology to automate savings, investments, and bill payments. This ensures consistency in their financial habits and reduces the risk of emotional decision-making. Avoid lifestyle inflation. As their income increases, they resist the urge to immediately upgrade their lifestyle. Instead, they channel extra income into savings and investments. Embrace delayed gratification. They understand the value of sacrificing short-term pleasures for long-term gains. This allows them to make decisions that benefit their future selves. Continuously educate themselves. They stay informed about financial matters, regularly reading books, articles, and seeking advice from experts to make informed decisions. Take calculated risks. While they're not reckless, successful people understand that some level of risk is necessary for growth. They educate themselves and take calculated risks in investments or business ventures. Give back. Many financially successful people engage in philanthropy or mentoring. This not only helps others, but also reinforces an abundance mindset. Surround themselves with like-minded people. They cultivate relationships with others who share their financial values and goals, creating a supportive network for growth. Practice patience. They understand that building wealth takes time and are willing to stick to their strategies over the long term. Monitor their finances regularly. They keep a close eye on their financial situation, regularly reviewing their budget, investments, and progress towards goals. Negotiate effectively. Whether it's for a salary increase, a business deal, or a major purchase, they're not afraid to negotiate for better terms. Focus on net worth, not income. They understand that true wealth is about building assets and net worth, not just increasing income. To adopt these habits, start small. Don't try to change everything at once. Pick 1 or 2 habits to focus on initially. Be consistent. Practice these habits daily until they become second nature. Track your progress. Regularly assess how these new habits are impacting your financial situation. Be patient. Remember that lasting change takes time. Stay committed to your new habits even when progress seems slow. Learn from setbacks. If you slip up, don't get discouraged. Use it as a learning opportunity and get back on track. Lastly, let's discuss the importance of continual financial education and explore some valuable resources. Continual financial education is crucial because the financial world is constantly evolving with new products, regulations, and opportunities. Your financial needs and goals will change throughout your life, requiring new knowledge and strategies. Staying informed helps you make better financial decisions and avoid costly mistakes. It empowers you to take control of your financial life rather than relying solely on others. Here are some excellent resources for ongoing financial education. Books. Rich Dad, Poor Dad by Robert Kiyosaki. The Total Money Makeover by Dave Ramsey. The Millionaire Next Door by Thomas J. Stanley and William D. Danko. Your Money or Your Life by Vicky Robin and Joe Dominguez. The Simple Path to Wealth by J.L. Collins. Podcasts. Planet Money by NPR. Choose FE, Financial Independence. So Money with Farnoosh Torabi. Bigger Pockets Money, particularly good for real estate investing. The Dave Ramsey Show. Online courses. Coursera offers various financial courses from top universities. EDX has courses on personal finance and investment. Udemy offers a wide range of finance-related courses. Websites and blogs. Investopedia. Great for learning financial terms and concepts. Mr. Money Mustache. Focuses on financial independence and early retirement. The Balance. Covers a wide range of personal finance topics. NerdWallet offers financial product comparisons and educational content. YouTube channels. Graham Stephan. The Financial Diet. 2 Cents. Andre Jig. Financial newspapers and magazines. The Wall Street Journal. Financial Times. Barron's. Kiplinger's Personal Finance. Government resources. The Consumer Financial Protection Bureau offers free financial education resources. The Securities and Exchange Commission provides investor education materials. Professional development. Consider pursuing financial certifications like Certified Financial Planner, CFP, or Chartered Financial Analyst, CFA, if you're interested in a career in finance. Local resources. Many libraries and community centers offer free financial literacy workshops. Some banks and credit unions provide financial education seminars for customers. Social media. Follow financial experts and institutions on platforms like Twitter and LinkedIn for daily insights and updates. To make the most of these resources, set learning goals. Decide what specific areas of finance you want to focus on. Create a learning schedule. Set aside a regular time for financial education. Apply what you learn. Try to implement new knowledge in your financial decisions. Join a community. Engage with others who are on a similar financial journey. This could be through online forums, local meetups, or study groups. Teach others. Sharing your knowledge with friends or family can reinforce your own learning. Stay current. Make a habit of regularly checking financial news and updates. Be critical. Remember to evaluate the source of information and be wary of get-rich-quick schemes or advice that seems too good to be true. As we conclude this section on developing a wealth mindset, remember that your mindset is the foundation of your financial success. By overcoming limiting beliefs, adopting the habits of financially successful people, and committing to ongoing education, you're setting yourself up for long-term financial prosperity. Your journey to financial freedom is ongoing, and there will always be more to learn and ways to grow. Embrace this journey with curiosity, persistence, and optimism. With the right mindset and knowledge, you have the power to create the financial future you desire. Now let's delve deeper into the world of investing as part of our financial freedom blueprint. Diversification is the cornerstone of a robust investment strategy. By spreading your investments across various asset classes, you're not putting all your eggs in one basket. This approach helps mitigate risk and can potentially enhance returns over the long term. Consider a mix of stocks, bonds, real estate, and perhaps even alternative investments like commodities or cryptocurrency, depending on your risk profile. When it comes to stocks, think beyond just individual company shares. Exchange-traded funds, ETFs, and mutual funds offer instant diversification and can be excellent vehicles for both novice and experienced investors. These funds allow you to invest in entire markets or sectors with a single transaction, reducing the risk associated with picking individual stocks. For those seeking passive income, dividend-paying stocks can be a game changer. Companies that consistently pay and increase their dividends can provide a steady stream of income, which can be reinvested to compound your wealth over time. Look for companies with a history of dividend growth and strong financials to ensure sustainability. Real estate investment trusts, REITs, offer another avenue for generating passive income. These investment vehicles allow you to benefit from real estate ownership without the hassles of being a landlord. REITs are required to distribute a significant portion of their taxable income to shareholders, making them attractive for income-focused investors. Bonds, while often considered less exciting than stocks, play a crucial role in portfolio stabilization. Government bonds offer safety and predictable income, while corporate bonds can provide higher yields with increased risk. As you near your financial freedom goals, gradually increasing your bond allocation can help protect your wealth from market volatility. Don't overlook the power of geographic diversification. International investing can expose you to faster-growing economies and help hedge against domestic economic downturns. Consider allocating a portion of your portfolio to international stocks or funds, keeping in mind currency risks and geopolitical factors. The concept of dollar-cost averaging is a powerful tool in your investment arsenal. By consistently investing a fixed amount at regular intervals, regardless of market conditions, you can potentially lower your average cost per share over time. This strategy removes the emotional aspect of trying to time the market and can be particularly effective during periods of market volatility. As we progress on our path to financial freedom, it's crucial to regularly rebalance your portfolio. Market movements can skew your asset allocation over time, potentially exposing you to more risk than intended. Set a schedule, perhaps annually or semi-annually, to review and adjust your holdings to maintain your target asset allocation. Tax efficiency is often an overlooked aspect of investing, but it can significantly impact your journey to financial freedom. Utilize tax-advantaged accounts like 401ks, IRAs, and Roth IRAs to their full potential. The tax benefits of these accounts can substantially boost your long-term returns. For taxable accounts, consider tax-efficient investments like index funds or ETFs, which tend to have lower turnover and generate fewer taxable events. As your wealth grows, don't shy away from seeking professional advice. A financial advisor can provide valuable insights, help you navigate complex investment decisions, and ensure your strategy aligns with your overall financial goals. Look for fee-only advisors to minimize conflicts of interest. Remember, investing is not just about maximizing returns, it's about managing risk. Understand the concept of risk-adjusted returns. An investment that offers slightly lower returns but with significantly less risk might be more suitable for your financial freedom goals than a high-risk, high-return option. Alternative investments can add another layer of diversification to your portfolio. While traditionally reserved for institutional investors, options like private equity, hedge funds, and real estate crowdfunding platforms are becoming more accessible to individual investors. These investments often have a low correlation with traditional asset classes, potentially improving your portfolio's overall risk-return profile. Don't underestimate the impact of fees on your investment returns. Over time, high fees can significantly erode your wealth. Opt for low-cost index funds or ETFs when possible, and be wary of investments with high expense ratios or frequent trading costs. The power of compound interest cannot be overstated in your journey to financial freedom. Start investing early and reinvest dividends and capital gains. Even small amounts invested consistently can grow into substantial sums over decades, thanks to the magic of compounding. As you build your investment portfolio, consider the role of insurance in protecting your wealth. Adequate life, health, and disability insurance can safeguard your financial future and that of your loved ones. Long-term care insurance might also be worth considering as you age to protect your assets from potentially catastrophic healthcare costs. Staying informed is crucial in the ever-evolving world of investing. Dedicate time to financial education, whether through books, reputable online resources, or financial seminars. However, be wary of get-rich-quick schemes or investment fads. Stick to time-tested principles and approach new investment opportunities with healthy skepticism. Environmental, social, and governance (ESG). Investing is gaining traction among investors who want to align their portfolios with their values. While the jury is still out on whether ESG investing leads to superior returns, it can provide a sense of purpose and potentially mitigate certain risks associated with unsustainable business practices. As you approach your financial freedom goals, consider the concept of a bucket strategy for your investments. This involves dividing your portfolio into near-term, medium-term, and long-term buckets. The near-term bucket focuses on capital preservation and liquidity for immediate needs, while the long-term bucket can be more aggressively invested for growth. Don't forget about the role of cash in your investment strategy. While not technically an investment, maintaining an adequate emergency fund in easily accessible, low-risk accounts can prevent you from having to sell investments at inopportune times to cover unexpected expenses. As your wealth grows, estate planning becomes increasingly important. Consider setting up trusts or other vehicles to efficiently transfer wealth to future generations or charitable causes. This can help minimize estate taxes and ensure your legacy aligns with your values. Behavioral finance teaches us that our emotions can often lead to poor investment decisions. Be aware of common biases like loss aversion, anchoring, and herd mentality. Developing a disciplined investment approach and sticking to it can help overcome these psychological pitfalls. Remember, the path to financial freedom through investing is a marathon, not a sprint. Stay focused on your long-term goals, remain patient during market downturns, and resist the urge to make drastic changes based on short-term market movements. Lastly, as you progress on your financial freedom journey, consider the concept of enough. While growing your wealth is important, true financial freedom comes from aligning your investments and financial decisions with your personal values and life goals. It's not just about accumulating wealth, but about using that wealth to create a life of meaning and purpose. Thank you for joining me on this financial journey. Remember, every step you take towards financial literacy and responsible money management is a step towards a more secure and prosperous future. Here's to your financial success!